Good afternoon and welcome to Markets Today. Second day of trading after we saw the oil slump 30% on an intraday basis yesterday at the beginning of the trading week. What is happening? There has been a bounce back in local and global markets on an overnight basis, largely driven by the pronouncements of the US President, that is President Donald Trump. He did say he would be injecting an economic stimulus into the economy by way of reducing the payroll taxes. Now, this has been interpreted as a positive to the market, and we have seen the equities actually close slightly higher than they had actually opened yesterday in the US. And we've also seen global equities recover somewhat earlier on in the trading day. For Kenya, recall yesterday we had seen a mighty drop, like almost some of the blue chips hitting a 10% low and closing at about 7% lower over the day. Safaricom, which was the leader of the blue chip yesterday in terms of price losses and closed at 27.5, has regained ground today. So far, it has traded 16 million shares. It did hit a high of 28.6 shillings over the day, and it has now tapered off at the 28 shilling mark. That's about 50 basis points ahead of what it closed at yesterday. We've also seen a strong rebound on the KCB share, which had closed down at 7% over the day. It's now trading at 49 shillings per share. It looks like what happened yesterday was a one-off event and more sentiment-driven. We always reiterate, the fundamentals of these Kenyan companies have not necessarily changed. And if anything, the price drop in oil is actually a positive for the macros of Kenya. That said, we do see that the prices might continue at the current levels where they are, but we will be looking for any indications as to ascertain whether this is a dead cat bounce. In other words, is it just a one-off, or do we expect a continued slide over the day? That's a conversation we'll certainly keep you posted on. Now, looking at Kenya from a macro level, the Parliament's Budget Appropriation Committee has reviewed the coming fiscal year budget and given its pronouncements. What has it said? What does it like? What does it not like? This is a conversation we want to cover today to understand what next in as far as the budget cycle is concerned as we come to the tail end of this cycle, expecting a reading of this at the end of the current fiscal year. Churchill Ogutu is a senior economist at Genghis Capital, and he is joining us today to evaluate his report. Welcome to the show, Churchill.
Thank you, Mbide.
This is certainly a well-written report, but I know you're eager to talk about it. But before we talk about it, Churchill, the slump on oil prices, what does that mean for Kenya at a macro level?
Thank you, Mbide. As you've just alluded to, it's a positive, looking at the fact that fuel and lubricants account to roughly 17% of the imports that we had last year. So a slump on that means that in terms of the value that we are, in terms of the monies that we're using to import the fuel, at least we'll get it at a much more cheaper price, or the value will be quite less. On a more small scale, we know that there is exploration or mining drills in the northern frontier of Kenya.
Okay.
So that will be it will disincentivize even further exploration or the drilling. And we know that last month the Tullow Oil announced that they are reducing even the workforce. So I think that if the global oil prices still continue below $40 per barrel,
yes,
I think there'll be a less compelling case to see a further exploration in the northern frontier of Kenya, and because the unit cost will be higher than the unit revenue, so there'll be less a compelling case. So we'll see further reduction in terms of further exploration if oil remains at this current level.
At this current level.
On a grand scale, we're saying that it's a plus for us.
Okay.
Kenya being a net importer nation.
All right. And in terms of what happened yesterday, and we have seen pronouncements from His Excellency President Donald Trump, really alluding to the fact that this is child's play. Russia and OPEC are just having a silly little debate, and it's neither here nor there. When you look at it fundamentally, do you actually see this slide in oil prices being sustained for more than the short term?
I think it's, to me, I find it's a retaliatory from Russia from the fact that there's been sanctions being put in Russia, so they are coming up to retaliate. This is the opportunity moment for them to come to retaliate, which led to the breakdown in the talks that was there at the tail end of last week between now OPEC and also the non-OPEC countries.
Okay.
That said, well, you find that even in terms of these producers, that level, optimum level, in terms of the oil price that they see, at least to balance their revenues,
Yes.
most of these countries depend primarily on oil revenues. So even a slump in oil revenues means that some of them are detrimental. And more so, I could quote the Latin American producers. Most of them, they have social reforms. They are more pro-socialist countries, so they tend even to fund the expenditure tend to be more of populist. So I find that now at these current levels they are quite hurting, if I may put it that way. And in terms of Russia, I think they have another hedge because they have significant natural gas reserves. So at least in the slump of oil, at least they can hedge with natural gas, which is they are quite big an exporting country. In terms of natural gas, yeah.
Okay.
In terms of US, I find it now, even the fracking industry, at these current levels, there's no case for them. So I find that most of those companies which were in the shale industry,
Yes.
they'll start defaulting if these prices persist or they keep tanking lower. So I find that where Trump is coming from with the stimulus policy, at least to reduce the payroll tax, it's more of a stimulus way, as you clearly put it. But then again, you look at it, the budget has to be balanced. Where is this deficit coming from? Will we see a reduction in spending or some less priority areas being cut, or we'll just see the budget still maintained as it is? So that's the big question, because that will dictate whether now they'll be able to borrow more, or they'll be able to, if at all, they maintain the spending at current level, or if they reduce the spending in tandem to the slash in the payroll tax, we'll also see it balancing off.
But borrowing more might be a bit of a tricky affair, because the Fed rate did, the Fed did cut the rate by a material sum last week, and the yields are actually sub 1%. So does it even make sense for them to issue domestic paper?
Yeah, it's quite a tricky balancing affair, to be honest. Yeah. Also, just touching on that, I see that rate cut didn't have a significant impact. Reason being, it's addressing the demand side of the economy, but on the supply side, most of the companies, and also what you've seen even yesterday's session, whereby some of these indices, US indices, had 7% decline intraday.
Yes.
So you find that now investors are actually looking at it in terms of the viabilities of some of these businesses, which is now partly addressed in the supply side. So that's the main concern in this environment, the coronavirus, the Russia, Saudi Arabia tiff. So most of the investors are looking at it in terms of the viability.
Yeah. But I think what it just says, just at this point, just keep abreast of Trump's pronouncements, because they're certainly directing what market is doing and the sentiment there. But enough about the global landscape and what's happening there. Let's come back home, and we are looking at your report, which evaluates the Budget and Appropriations Committee pronouncements on the current budget policy statement. What is the Budget Policy Committee saying, and what is it like, what is it not like in this statement?
Well, the Budget Appropriation Committee came out quite strongly in terms of even adherence of the budget policy statement by Treasury, and it singled out that the fact that year in, year out, there's been a lack of adherence in BPS. And one of the things that they came out strongly is that if there's a revenue ceiling or there's a spending ceiling which comes out in the budget policy statement, by the time the budget is presented to Parliament, the revenues, the spending are more or less not adhered to as per laid out in the budget policy statement. So that really quite stood out. The other issue that stood out is in terms of the debts. If you look at the debts environment, one of the things that even gave them a bit of some ammunition to the both houses, that's National Assembly and Senate, to change the debt ceiling to an absolute figure of 9 trillion shillings last year in October, was the fact that now Treasury had stated that it will now move to concessional funding. But if you look at the budget policy statement, you find that in terms of the amount that is required, even in terms of the commercial financing, because the idea was now we move away from commercial financing and we go to concessional financing. But I find that if you compare in the current financial year, the commercial financing target is around 213 billion. For the next financial year starting July, it's gone up to 274 billion. So those are some of the questions that National Assembly through the Budget Appropriation Committee is asking, that wait a minute, there's this focus to move towards concessional financing.
Okay.
How come commercial financing has gone up?
Yes.
So those are some of the issues that even the committee report has raised, and to the extent that one of its policy recommendations is that before the budget estimates, which is scheduled to be tabled by end of April, that now Treasury has now to come with another macroeconomic framework and also give the specific targets in terms of commercial loans, in terms of semi-concessional loans, in terms of concessional loans for the next financial year. So at least to make it a bit clearer.
It just sounds like pushing paper. It doesn't sound like anything has changed, really.
Well, yes.
Because it feels like the Budget Appropriation Committee is... It's blowing hot and cold and saying, okay, you're not following the framework, you need to do this documentation, we're not receiving this documentation. But it sounds like more of an administrative task, but it does feel like their hands are tied. Can they actually do anything about the budget policy statements, about the fiscal policies, about monetary policy?
To the extent that I will put it that they have the last say in terms of even the approval of the budget policy statements, because it's not that National Treasury operates in a vacuum. They have to submit it to cabinet, and now after being submitted to cabinet, it has to be presented in parliament, and then the budget appropriation committee has to approve and also give its recommendations. So I think that from that point they have sort of the final say in terms of how even the policy implementation in regards to the budget works out. So they act to bring in some checks and balances.
So there are checks and balances.
Exactly.
All right. So at the beginning of your report, you do say that the appropriation committee has come up with some policy considerations for Treasury to take into point and focus. For example, export-led growth strategy, which is expected to boost foreign exchange earnings. What is the appropriation committee in detail, not in detail, like specifically proposing in line with this?
If you look at in terms of even the growth scenario, we're looking at even the kind of the policy in terms of our growth. One of the things they pointed out is a bit skewed. There's a bit of some asymmetries in growth potential, whereby the growth is between 5 to 6%, but no people on the ground are not feeling it.
No one is feeling it.
No one is feeling it, And now it boils down even to what kind of policies we have in place. Of course, we know that there's a Big Four agenda. One of the things around it is now to spur manufacturing to 15%. And a secondary item towards it is now the export-driven agenda. But you haven't seen it forthcoming. So
why is it not? Okay. Let me ask it differently, Churchill, because this is a good report, and what the appropriation committee is saying is valid. But as I like what you have said, that people keep saying the economy is growing between 5.5% to 6%, depending on where you're seated on. But the economy, the constituents of the economy do not feel it. And what we keep hearing is there's a lot of push and pull in terms of this is what the documents say, this is what we need to do. So we keep hearing big words being thrown about. We need to be an export-led economy. We need to be. Why are we not being all these things that all the technocrats and all the political elite are saying we need to be? Like, for instance, now on export, the parliamentaries, they say that we need to be an export-led community. The politicians are singing the same song. If you go to Treasury, if you go to Central Bank of Kenya, we need to be more export-led so that we can raise our foreign currency, etc. But why is it that these things can't be done?
Well, let me just answer one of the one of the first questions that you raised, why is it not being felt? You realize that in an economy, there are producers and there are consumers, and the majority in the Kenyan context, most of the people who are not feeling the growth are now consumers, you and me, who
Yes.
have some discretionary money, that disposable money rather, that we get, but you're not feeling it, rather, whereby statistics say that you're growing by 5%, 6%, but you're not even feeling it in our pockets. So hence, that's the main thing. But now, if we find an economy which is now favoring the producers,
Yes.
which I could say is the case that it is right now, that's the end result, that you find that a significant mass of the citizens are not feeling the growth here.
Okay.
So that's
How
the
is
context.
it then favoring the producers? The electricity is not cheap.
Well, in
Labor
terms
is
of
not okay.
in terms of giving incentives, and one
Yes.
of the things even had been raised in the draft budget policy, that there are some tax incentives that had been put in place, but in the final report, it's not even there. So to
Oh,
that
so they are no
extent,
longer-
we
okay.
can just say that not that it's no longer there, that there should have been a comprehensive audit of the incentives going back the last 5 years. But in the final BPS report, that proposals is missing.
Okay.
So to me, it just gives us, just to give a sense that it's just more or less favoring the producers. So I find that yes, in as much the growth is 5%, but it's at the top pyramid of the economy, not the consumers who have a significant base at the bottom of the pyramid. Yeah.
Okay.
So more towards it. And
More
if
towards
we
that.
go
All
to
right.
that aspect about the export-led growth, you find that that train has already left the station, if I may put it that way, because traditionally we've been known as a major exporting nation, traditionally, or way back. And if my memory serves me right, I remember, or reading through the history, there was this significant boom in 1970s whereby coffee benefited largely in terms of whereby there was a depreciation in the Kenya shilling vis-a-vis the dollar. So there was a bit of a coffee boom. Most of the people, I don't know
Yes,
if you
there
and me
was.
were there.
No, I
alive
wasn't there,
that
but at
point,
least
yeah.
for the coffee boom, what I remember, and sorry to interject, is at least I had when I went up country, that when it started, there were people who would organize everybody else, and it would be like, Sasa kahawa is the next thing. We all
Yeah.
grow kahawa.
Yeah.
And I can imagine the excitement then when people were excited that we'll work hard but we'll be able to earn. But nowadays, I really struggle to see what's the next thing. I struggle to see, what am I going to tell you? What am I going to tell my relatives? What am I going to tell my peers? Like, come, we do this, we build our country, we build ourselves, and we also build our earnings power.
And that is also the point I also see, or something I can poke in terms of the
Yes.
medium-term vision 2030, because you find that we are still going back to the primary products produce, the coffee, the tea, but yet again you find that we are competing in a global landscape. China have moved down from that agriculture side, they have moved up the value chain, they are into services, or not even
Yes,
China, but even the
services.
Far East
I like when you bring out
Asian,
services.
Far East Asian nations. So I find that even their export, they're trying to add more value add. So if the priority is in terms of the primary export side, we find that you are missing a lot, will be really out-muscled by these other competitors. Hence, the strategies should be trying to find ways of moving up the value chain, or trying to find ways of even increasing the value of the primary produce such that we become attractive in the global market. So unless those issues are addressed
Yes.
comprehensively, we'll still
Okay.
be fighting a losing battle.
And maybe those ones are beyond my pay scale and your pay scale.
Exactly,
Okay, let's go
exactly,
back
yeah.
to the revenues then.
Yeah.
What does your report talk about the revenues from Parliament's perspective vis-a-vis Treasury's perspective?
We're looking at a scenario next financial year that revenues will jump from 2.08 trillion in the current financial year to 2.13 trillion in the next financial year. That's the overall revenue estimates,
Okay.
of which ordinary revenue for the next financial year will be around 1.86 trillion. But yet again, if you look at the statistics for the current financial year, the data that we have is for the first 7 months between July last year to January this year, whereby revenues underperformed by 104 billion.
What were revenues? What was the absolute number?
The underperformance in revenue. So absolute was around 897 billion.
Okay.
So they were targeting around 1 trillion, but they
were able to get slightly below.
Yeah, slightly below that one by 104 billion. So the case is, why are we increasing revenues for the next financial year, yet even the performance for 7 months
this current year
is not even up to par? So it just leads to the credibility of, in terms of what will happen in the next financial year, that will lead to an increase in revenues. So Budget Appropriation Committee was coming up with that proposal that perhaps there should have been some elaborate expounding of what are the necessary tax proposals for the next financial year that we could see an uptick in revenues, but that also hasn't come out. So you're seeing a scenario whereby it's just business as usual as per what it was.
Then does this mean that we should expect additional tax lines? Because I mean, what you're saying is we will be taxed, those of us who have already been paying tax to the government. We have to find a way to cough out 1.68 trillion in ordinary revenue for the next year.
That is now what is intended.
Yes.
But even as things are looking by, we are likely to have a supplementary budget, which will now reduce even the revenue and also the expenditure for the current financial year.
Okay.
So this will be the second supplementary budget in the in the financial year. This could ideally come before end of this month or by mid next month, because remember that the budget estimates for the next financial year will be tabled by around April. So I think they want to do away with this issues to do the current financial year,
so that they can close it.
Yeah, so that they can close it. Yeah.
Okay.
However, I still feel that there still be some strains in revenue collections, having underperformed by 103 billion, and say we are meant to reduce that budget to by 103 billion. And Makio, there's still a financing gap, even in the current financial year, to the tune of 91 billion. So you're looking at around 200 billion reduction in spending. What's the impact of that if you reduce spending even in the economy? There's no multiple effect. So it also means that even going forward in the event that there's a supplementary budget, say in April, we still have 2 months in the financial year, and there's still some cuts in the same year in the spending.
Okay.
It means that even there could be some revenues that could lost, that we could lose in terms of the other 2 months in the financial year.
But then when you look at the expenditure and the breakdown, I mean, maybe take us through this, because it does feel that the bulk of this expenditure is recurrent. So if we're going to cut anything, it means we will not have any development expenditure.
Yes, yeah. For the next financial year, we're looking at 1.84 trillion in terms of the overall spending, of which recurrent is 1.22 trillion and development is 618 billion.
Okay.
Of which,
and this excludes any payments for debt.
Yeah, this is just on the national
primary
government.
Okay.
The money is towards the executive, judiciary, and parliament.
Wow.
Of which even the development spending, there's a slash of to the tune of close to 150 billion reduction. And to me, I think even as you move to this scenario that there could be a second supplementary, the biggest loser of that will be development spending. It's usually easier to reduce spending to development, to the projects, rather than to the recurrent, so that we could see even impacting in the economy. So in as much as in absolute numbers, it has this lowest amount which is being given development, yet it has the biggest cuts even in the media budget. And that's also the other thing that even the BAC committee raised in terms of in-year budgets, which are more inclined to reduce development spending.
All right. I mean, I'm looking at these numbers. So you're saying ordinary revenue will be about 1.7 billion estimate.
Yeah, 1.8 billion.
1.8 billion,
yeah,
sorry.
1.8 billion,
assuming for some given reason the government is able to raise 1.8 trillion, how much of that would go to ordinary expenditure?
Well, there's that split between this First of all, it's the Consolidated Fund Service.
Okay.
Consolidated Fund Service is now the interest payments, is now a bit of redemption, is some pensions for the civil servants. So that roughly accounts to around 580 billion
Okay.
as per this budget policy statement.
So let's round it off to about 600 billion.
600 billion, yeah.
Okay.
Yeah, 600
and then
billion.
wages?
So it means wages around another 400 billion.
So you're okay. So you're already at $1 trillion.
Yeah, already at
and
$1
then
trillion.
what else? What about the county
there's
allocation?
now operations and maintenance.
Yes.
Which is also part of that. And also you brought another interesting point. The equitable share to counties is now 316.5 billion.
316.
So you find that all these are now funded from the revenue, from the ordinary revenue.
Wow.
The balance now ordinarily
Would go to
development spending,
Okay.
will now be funded from debt.
Okay.
Yeah.
Because I mean, I'm looking at it, and I always try and compare the macro and the micro. So what is happening at a national level vis-a-vis what is happening at an
Micro level,
individual household level.
Exactly.
I mean, you have this is where your revenue is,
Yeah.
but you're consuming almost all of it. You really don't have space to make any investments, and that's how your typical household actually runs. So what is happening at a national level is purely reflective of what happens at an individual level, because what happens at an individual level then now has allowed for the mushrooming of mobile lending. And it has shot through the roof because people are constantly there on a weekly, on a monthly, on a regular basis, always topping up to be able to enhance consumption. And I bring that point out because I feel it's a very pertinent conversation to us, steering the conversation away from the government is not using its resources well, to asking, how did we get here? Why are we consuming all that we are making in revenue? Is it an African issue? Is it a global issue? Is there anything we could possibly do to change the fact that we consume about almost everything that we are able to generate?
I think it's a global issue, not only isolated to Kenyan market, but it's a global issue. For instance, if you look at the US, one of the triggers for the 2007 financial crisis was this household debt, whereby there were a lot of incentives from a macro level, whereby the Fed rate was at multi-year lows.
Yes.
After the 2001 the terror attack.
Yes.
So
the 9/11.
So there was a bit of some sequence of reduction in the Fed rate, so they were at low level for the longest time, and it acted as incentives for now the household now to come up, get their mortgages, and then there's all these kind of sticks.
So it happens everywhere.
Carrots, from the banks to get people to subprime mortgage rates.
So then if you're saying it happens everywhere, you've given us an example of what happened in the US following the 9/11 as well as the housing boom that caused a collapse of financial markets. The question is, should we then even bother investing? Should the government of Kenya even bother with development expenditure then? Does the US government bother with expenditure and development, or are they far along the economic cycle? But before you answer that, Churchill, I have to take a quick break. We take a quick break to look out for the NSE closing, and we will be back shortly.